Hi folks, Navy Dowdy here. Believe it or not, there are still some things you can do to save taxes for last year's income. Most tax savings ideas end on December 31st, but there are a few exceptions. Number one, contributions to IRAs for last year's income can still be made right up through April 15th. You can deduct $6,000, and if you're over 50, you can deduct $7,000 against last year's income. Your spouse can do the same, even if only one of you has income. Now, naturally, like everything else in the tax code, there IRS gives and the IRS taketh away. So if you have too much income, then you're not able to make that deduction, and that income starts at $105,000. So if you have another retirement plan at a job where you're working for somebody or yourself for that matter, and you can contribute to that other retirement plan, then it starts to phase out. The ability to deduct the IRA starts to phase out at $105,000 and is completely gone at $125,000 for the person that has the other retirement plan at another job or at work. However, the spouse can still make the contribution. The spouse's ability to make a deductible contribution starts to phase out at $198,000. So just know that if you have income under $105,000, then you can deduct the IRAs right up through April 15th. The second thing that you can do, and this is the big game changer, is that you can contribute to your own 401k plan if it is for your own business. If you're working for somebody and you have the ability to contribute to their 401k plan, that contribution deduction ends on December 31st. If you have your own business, you can contribute and get the deduction right up through the tax payment deadline, which can be extended to October 15th of this year. Now, here's what's really revolutionary. Up until this year, you had to have your retirement plans, I'm talking about mainly your 401k type plans, in place by December 31st of last year. For this year, and I don't know if it'll still be true next year, but for this year, you can now go get your taxes done, see how much you owe, and say, wow, I owe too much. How can I make a deduction? Well, like I said, you could do it with your IRAs if you don't have too much income, but now you are allowed to set up those deductible plans like a 401k plan right up through next October. Now, don't wait till October 14th to try and set the plan up. But the point is that this is revolutionary. This is a complete game changer. You can now do your taxes, figure out how much you owe, and then go set up the plan to get the deduction and reach back into last year. So the limits are for your own solo 401k plan, $58,000. Now you have to have plenty of income to deduct that, so there's a calculation. Just know that that's the upper limit of what you can deduct for a 401k plan. If you have a lot of income and you really need a lot of deductions, under the right circumstances, you can set up a different type of plan and deduct up to $343,000 against last year's income. That has to be earned income. But that's a big game changer. The next thing you could do is add back your missing deductions. And this, with small businesses, there's always missing deductions. There are many business deductions, home office deductions, equipment deductions. There was a debate a few years ago of whether they were going to continue Section 179 deductions. Some people wanted to get rid of it. Some said, nah, we'll just renew it year by year, but now it's in the code and you can deduct up to $1,040,000 of equipment that you bought. You used to have to depreciate it, but now you can deduct it as Section 179 deductions. Now, if you have too much income, that starts to phase out also. But that can be a really big change. Almost all small businesses are missing these deductions. A couple other things you could do if you had rented your home out to your business or to anybody for that matter for 14 days, that is tax-free income to you and it's deductible to that business. If you have an office building that you're operating out of, you might look at cost segregation and redo the depreciation on the building. And then fourthly, let me throw in one extra little thing, like a quirky little thing. It's called opportunity zones. We have people come in all the time that say, you know, we sold our business or we sold a piece of real estate last year. What do we do? Well, if you give me 2 years, I can show you 20 ways to avoid the capital gains tax or delay it or eliminate it or minimize it. But if you come in and you say, you know, I did it last week, and I had 2 people come in the last week. One that sold a big piece of property, had a huge gain, and the second one sold his business. Both of them, by the way, closed on December 31st. So what can they do? About the only thing left for them, other than offsetting that with the business deductions that I just talked about, is opportunity zones. Opportunity zones are now in the code, and it's a kind of a unique thing. They will allow you, if you invest money in opportunity zones, which are designated by the governors of the various states, to delay that capital gains tax and for 5 years, and then secondly, any gain on the property that you buy beyond what you put into it will be forgiven if you hold it for 10 years. So that's a limited application, but it is part of the code. And why I'm telling you about it right now is that they made a rule change that said you have up until March 31st to reach back into last year. And if that's something you need to know about, just give me a call. You can call my tax office, 630-893-4142. So where do you get the money? One of the things that happens sometimes is that people say, you know, I'd love to make those IRA contributions. I've got some money coming in later, a couple months from now. I just don't have the money to make the contributions right now, or the contributions to your big retirement accounts right now. Well, you can delay the retirement account contributions until October, but the IRA you have to make right away. So what could you do? So one of the things, obviously, just take it out of your checkbook. That's easy. But could you do this? Could you take a withdrawal from a different IRA that you have? Let's just say husband and wife have $50,000 each in an IRA. Could they make a $7,000 withdrawal from that IRA, causing a taxable event for this year, and then put that money into a new IRA that will give them a deduction for last year? And the answer is yes, you certainly can do that. Now, if you're under 59 and a half, there's a penalty to do that. So that's going to apply mainly to people over 59 and a half. But the rule is, if you then put that money back, maybe you have some money coming next month, put that money back in that IRA within 60 days, then it's not taxable. It's like nothing ever happened. So think of what you did. You got a deduction for last year. You didn't damage your tax for this year. What else could you do? You could get loans. You could borrow the money. Well, where could you borrow the money from? If you have 401ks, you certainly could borrow the money out of the 401ks if it's yours or if it's an employer of yours, if that provision was put in there when it was set up. When we set up 401ks for companies, we always check the box that says the employees can make loans. You could also do the same thing with your 403b plans if the provision is in there. You could also just borrow the money on your home equity line of credit on your home or from anybody else, your parents or siblings or neighbors, whoever. The point is, if you need the deduction and you've only got a couple weeks yet to get that deduction, get the money from someplace and then take the deduction. For for last year's IRAs. Now, let me hasten to say, you can only do that borrowing from or taking money out of your IRA and then putting it back within 60 days, one time per 12-month period of all your IRAs. So it was a big ruling a couple years ago that shocked everybody. Only one 60-day rollover per person in a 12-month period. So this is week 1 of this tax savings, the 3-week class that I'm giving. And if you want to know about week 2, which will be about how do I save taxes on this year's income, because remember, this year is already a quarter over. A lot of the things that you need to do to save taxes this year are already a quarter of the year past. So every day that goes by, you're missing tax deductions for this year. Some of them you can't retrieve. So, and then the 3rd week will be how to save taxes overall, over your lifetime for you and your family. Click the button below if you want to know more about those 2 second parts of this 3-week series. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.